This is Annuity Straight Talk. Since 2008, your host, Bryan Anderson, has helped clients nationwide navigate the complex market for annuities. With Bryan's assistance, hundreds of clients have achieved a profitable and secure retirement. I would know, because Bryan has answered many of my questions concerning annuities and retirement planning. So that you can benefit as well, let's get started. Here's Bryan.
Hello and welcome everyone to the Annuity Straight Talk podcast, episode number 14. My name is Bryan Anderson, founder and creator of Annuity Straight Talk, and my co-host, Ashok Ramji, out in Seattle, Washington.
Welcome, everyone. This is Ashok Ramji with Top Planning. Welcome to another episode of Annuity Straight Talk.
And what are we? So we talked about this. You came up with a pretty good idea. It might seem a bit mundane, but it's not. It's actually very important for people to understand so that it's not one of the issues that holds you back from doing the right thing in retirement. So what idea did you have for us today, Ashok?
I thought we would talk a little bit about surrender fees. You had an article that was put out in 2020 that basically said why surrender fees aren't a big deal when we look at annuities. I thought we would look at that article, but first we're going to take a step back, explain why fixed deferred annuities, for example, have surrender fees. I know other types of annuities have them as well, but this is the wheelhouse you and I work in. We would consider the pros and cons of those. And hopefully, as people are looking at where to place their money for their retirement savings, they may say, you know what? If I've got to put money into a fixed deferred annuity and there's a surrender fee schedule, maybe I don't do that. And so hopefully this podcast will give people something to consider, some perspective, and maybe some solutions. That's where I think we'd like to go in this episode.
Okay, good. Well, and I agree with you. And I will say the biggest reason why you have a surrender fee on a contract is because it's free, no matter what anyone else says. So long as you don't add anything additional to the contract, any riders, guarantees, lifetime income, death benefit, otherwise, your contract is free and you pay no fees to own it. And so what's interesting is I think a lot of people, I say it's surrender fees are the stick used to beat annuities. And a lot of people don't understand. You look at it in the context of other investments. It's actually a pretty dang good deal so long as it's done correctly in the portfolio. Now, with a contract, if you put $100 into the contract, Ashok, you and I get paid to sell it, right? The insurance company's got administrative fees, investment banking fees, all sorts of stuff. They've got a big operation, marketing. They got marketing costs. And so they're actually paying money for you to own the annuity. What you have to do in the surrender fee is it's like a contingent deferred sales charge on, what is it, B share mutual funds or something like that. Cost declines over time. And essentially what that is doing is the insurance company has to ensure some way that you keep your money there long enough so that they can not only get their money back, but they can make a little bit of a profit. And I don't know who wouldn't want the insurance company to make a profit, because if they're making money, they're strong, they're stable, safety's the key, you got your money guaranteed. And so don't be a cynic that says, I don't want the insurance company to make money. Is that a fair shot at what they mean?
I would agree with you, because at the end of the day, when people are looking to place their retirement savings into some sort of vehicle, they may look at putting it into a certificate of deposit at a bank. The problem is, at the time we're recording this in the early 2020s, interest rates have stayed at historical lows. So, and we're seeing reports of purchasing power being eroded. So there's a real concern that net of will purchasing power be lost if you're getting a very low return on your money, say maybe like 1% for a period of time, right? So on the flip side, someone can put their money into market-oriented investments. Hey, I like those a lot, but there's always the risk of those going up. It's not a risk, but that would be a nice return. but they can also go down. So what the insurance company is providing for society is to say, here's a way for you to place your money on deposit. And if the markets continue to perform, especially in a fixed deferred annuity, if it's tethered to an index, if the indices go up year over year, you're going to get a nice credit. They have to earn a little bit of a profit margin in order to keep doing that year in and year out. So this is why the surrender schedule is important, is because they need to know that they can have that money on deposit for a while rather than it being fast money in and money out.
Right. And that's the thing. I want insurance companies to make money. Again, for the cynical people, think about how much money a bank makes off of your CD or your money market savings account. They're paying you 0.5%, and maybe right now it's pretty rough. But you put $100,000 in there, and they get to loan $1 million on it, and they're making 3 or 4% on $1 million, so they're going to make $30,000 to $40,000 a year and pay you nothing for the pleasure. So nobody can tell me that insurance companies are out to screw people. It's the banking industry that's the biggest perpetrator. I don't know. That's my opinion, Ashok. What do you think?
Well, I'll just say that we like working with the insurance carriers. I'll be diplomatic, right? But I'll say that we like to just guide clients to saying, when we work with them, this is the purpose of money. This is what we're trying to accomplish. You and I will go through the application and make sure when we're designing some of our cases, maybe we might use a ladder. Maybe we might have some short surrender schedules. Maybe we'll have some longer ones. Maybe we'll mix them up. But I think fundamentally, at this point in time, if people are looking to grow their retirement savings and do it safely, the fixed deferred annuity is a very compelling choice. And it would be a shame for someone to look at that surrender fee schedule and make a determination, well, this is not for me because, I'm going to lose my money during the first period of time that the surrender fee schedule is in play. So that's why I thought we would have this episode.
Okay, no, and I agree with you. And I think one good example, if you don't mind, I'm not afraid of taking shots across the bow, but Ken Fisher says plenty about guys like us. I'll say something about him. If you have $1 million portfolio with Ken Fisher, he's going to charge you about 1.5% to do it. So that's $15,000 a year in nominal dollars over a 20-year retirement. That's $300,000. If you factor in what that money would have grown to, the lost opportunity cost on the money being in Ken's pocket instead of yours, it's going to be an astronomical difference, wouldn't you say?
Yeah. I mean, yeah.
And so if you take that and say, all right, well, half the money, just for simple terms, I'm not saying you put your half your money into an annuity, but in a simple scenario, if you put half your money into an annuity that's free, you just got a surrender charge. So you got to, within free withdrawals, you can take money out. You can use it for income. You can use it for rebalancing your portfolio, all sorts of different stuff. So your money's not just locked up, but you're going to cut your fees in half. So instead of paying $15,000 a year, you're going to pay $7,500 a year. And a lot of scenarios in the past, Ashok, we're going to have to do a little more detailed case study on this, but there's a lot of times where when you have the right protection component, you actually get more growth over time, over several periods throughout history, where you'll actually have a higher portfolio value for limiting the volatility. And if you think about, instead of paying $15,000 a year, you pay $7,500 per year, that's going to make a demonstrable difference in retirement. You're looking at recapturing half that money and not just keeping it, but also growing that basis. And so I think it's just one thing people need to really understand what's going on. And again, annuities have to go in the right context. You got to have guys who know what they're doing and put them in the right way. We know RIAs, registered investment advisors all over the country, that are jumping on the annuity bus, and they're saying, yeah, these things are great. They work really well. So just a quick little example of how, the rest of the world works. Everybody's making money in this business. Just depends on if you want it to come out of your pocket or not.
I love when consumers have choices. So wherever people find value as they're doing their homework, if they want to place it with one investment manager, they feel like there's going to be value add, but there may be some costs along the way. What we're saying here is with these fixed deferred annuities, as long as they're implemented correctly, and remember, they are contingent deferred sales charges. It's contingent upon taking out more money than is freely available. Then if you honor those provisions, the money, there wouldn't be any charges during that surrender fee schedule period of time. So
yeah, and we've got a lot of examples, a couple examples later why that's not it's not likely to happen so long as you make the right choice for the right reasons in the beginning.
Now, Bryan, your article that we're going to review is why surrender fees are not a big deal, if you will. We do want to clarify that they are a big deal when you go into doing some planning, especially for, say, older clientele. We'll look at the surrender fee schedule on a fixed deferred annuity. We'll look at their age, and typically we'll make sure that that contract comes out of surrender before their estimated lifespan ends, for example. So when we do some case design, we may factor something like that. We may make sure that our contracts have a waiver. If somebody passes away, there shouldn't be a surrender charge applied for the beneficiaries. There may be a waiver for nursing homes. Sometimes there may be a waiver for terminal illnesses. Sometimes we're going to be designing our cases where we do some laddering. We're going to do a 3-year annuity. We might do a 5-year annuity, a 7 and a 10 years, always designed to give the client the liquidity that they need. So I just wanted to caveat that we do consider the surrender charges in our planning, but as we're going to explain, if we use it correctly, we can help, that doesn't need to be the chief impediment in our plan design. Is that fair?
No, that is absolutely kind of really good points to remember, is that when someone comes in and says, "Oh, I actually this morning, I was cutting up steak to make beef stroganoff, and I'm going to get to it after we're done recording." But one of my clients called, and he's 80 years old. He had a terrible bout with COVID and the blood clot issues where he actually had a leg amputated. He bought a contract from me 7 or 8 years ago. So he's been surrender free for a year. It was a 7-year contract. And, he called was always concerned. Well, what if I pass away? We talked about maybe getting him a new contract with, better terms, and we've decided to kind of keep it where it's at. But he said, I don't want to go into a new contract because then if I die, then my kids are going to have to pay that surrender fee. And so I guess I didn't do my job early, and obviously he's 80, he might have forgot a couple of things. I don't remember the exact conversations 8 years ago, but he looks at it, and I said, listen, if you move to a new contract, there's a waiver of waiver of surrender fees on death. And he didn't know that. And again, we still decided to keep his contracts where they were, but it's one of those things where you have to explain to us what your biggest concerns are. If it's someone saying, well, I'm 77 and I'm worried I don't need the money at all, but what if I go into a nursing home? Well, then what do we do, Ashok? You make sure if the annuity is the right fit, you find one that's got a nursing home waiver, and you look at the terms of that waiver and all that stuff. That way you've got an out on the surrender fee if the person gets into kind of that one position that they're really concerned about.
Correct. This is an important time to remember that if you have an annuity where you're kind of saying, wait a minute, I already have this annuity. What would it look like if I were to do some planning? It may be in surrender. It may be out of surrender. You may not have an annuity, and you may be thinking, okay, but what happens if I put my money into something with the surrender fee schedule? A good place to start, give us a call, 800-438-5121. That's 800-438-5121. Go to AnnuityStraightTalk.com, hit the green schedule a call button. I think, Bryan, what our listeners have found out is we will look at their situation. We'll ask them what's the most important. What are they trying to accomplish? And sometimes you might hear, don't work with us, and, we may not use an annuity in your situation. Or if you have an existing annuity and maybe it's still in surrender, maybe you just stay where you are. So give us a call. We're straight shooters because that's what we believe here at Annuity Straight Talk.
Yeah, and that's a great point, and that kind of goes back to the last episode where we talked about annuity maintenance. And I've had a lot of people. I service contracts that I never sold in the first place, so it's kind of a goodwill gesture on my part. People I like, people that need help. I'm here to answer questions for anyone, no matter who it is. And I could have probably along the way. I've got one that's coming surrender free this year, and I think I'm gonna advise the people to keep it. But I've been servicing that contract for 7 or 8 years now, and if I was interested in just stuffing my pockets, I could have probably convinced them to do something different. I could have they're good friends. They've done some other business with me. I like them a lot, but I'm not going to take advantage or breach that trust by just stuffing my own pockets with money. And so the fact that, if you got something you want to look at, if you can't contact the guy who sold it to you, I don't care if it's a variable annuity, a fixed annuity. I've met people that have had a single annuity for 35 years. I love the stories. It's interesting. So give us a call. It's, our goal is to help people, is it not?
It really is. That's always first and foremost. And if in our work together, it ultimately ends up in doing business together, so much the better. But if at the end of the day we part as friends, that's okay too.
Mm-hmm. That is true. So yeah. So what do we got for like the examples, the case studies?
Well, let's take your article, for example. This is from August 15th of 2020. We've got the article here, Surrender Fees Are Not a Big Deal. And the first point that you address is, and we've talked about it now, that when you're looking at an annuity, when we know that there's going to be a surrender fee schedule and there's going to be a period of time, annuities are not meant to be short term, like just put it in and put it out. So we're going with some methodical thinking of why this annuity is in the portfolio. And a key point that you say is that just like any type of thoughtful placement, you might decide, you know what, every year, let's reposition a portion of that. And with annuities, there's usually a amount that's traditionally about 10% of the money that can be pulled out each year with there's no penalties. So that's one example of why surrender fees aren't a big deal, right, Bryan? Because you have that ability to reposition a portion of that money every year.
Right. Well, and I say, that's kind of one of my stories, Ashok, where someone say, "Oh, I don't want the surrender fees," and I'll ask them, say they're 65 years old, it's an IRA. How long have you been saving money in your IRA? And they'll say, "Oh, for 40 years or whatever." And then I'll ask them, "How often did you touch the money?" "Well, I never touched it, never moved it, just sat in the IRA." "Yeah." "Okay. So what makes you think that being able to withdraw 10% is not going to be better than anything you've had before?" Now, again, it kind of speaks to, an individual plan, and obviously retirement's different when you're drawing on assets. But if you've kind of kept your money in one place for several decades, then, adding liquidity or actually having, it's almost like a guide, or, it gives you a framework with which to withdraw money and all that stuff. So my bet is that you're not going to be moving more than 10. If you got a good plan, you're not going to be moving more than 10% of your portfolio one way or the other on an annual basis. So again, I don't think it's a big deal because most people are going to set things in place, and a good plan has got, long-term perspective, and you're not going to make those, major changes on an annual basis.
Agreed. And one other point we've talked about before, let's just say that if somebody puts in an annuity with a 10-year surrender fee schedule, that's relatively a short period of time when you consider that someone who's, say, 17 years old, when they start working, they start paying Social Security taxes. Right now, someone who would be 17-year-old, their full retirement age is 67. So, and then the earliest you can tap Social Security is 62. So you've got to figure that there's a 45 to 50 year period of time that this 17-year-old is not really going to have access to the money that has come out of their paycheck. So sometimes when we think about annuities with a 10-year surrender schedule, it's a long period of time from one perspective, but from another perspective, it may not be that long. So just something to consider as we do our planning.
That is very true. So you've got, what was the, let's see, that was one. So we have two big reasons why I pointed to. So that's kind of just the theoretical thought of like, really, are you going to pull 10% of your portfolio in or out on an annual basis? And the likelihood is 0. And if you'd have to, then you haven't planned correctly. But in the article, there were kind of two major, like more concrete reasons why surrender fees are not a big deal. So which one, what do you think we should start with? Which one was it?
Let's start with you right here. The first is the fact that most index annuities have growth in the first few years that exceeds the surrender fee. Now, if it's okay, Bryan, what I'm going to do is I actually did a back of the envelope calculation to explain this. So we are going to, if you're watching this,
I think it's a good idea. Yeah. If you're on YouTube, you can check it out. Ashok's going to do a little illustration.
So what we have here is, I'm going to just share my entire screen because sometimes it's easier to do it this way. So hang on one second. I'm looking at your article right here. Okay. So here we have, Bryan, you do see the whiteboard, correct?
I do see it. Yep. You're there.
So what I have here on the screen is a 10-year surrender fee schedule, if you will. This is just made up, but this doesn't really deviate too much from what we see elsewhere. So let's just say that we have a 10-year schedule. We have our surrender charges that might start off something like 9% in year 1, 9% in year 2. And as you can see, typically what we see is these things tail off. So as we get to year 10, now the surrender fee may be 1%. So it starts high and then over a period of time, it just sort of tails off. Let's just say here, we'll take year 3 and let's just hypothetically assume that we still have an 8% surrender charge. That means that if you put $1 into that contract in year 3, you would have access to 92 cents of that dollar. The question is, what type of growth rate would be needed so that way, if you had some growth in the contract, you need to at least get back to your original principal, which was the dollar. So if I take $1 and I divide that by 0.92, mathematically, that works out to 8.7%, which seems, wow, you need a pretty decent rate of growth. But remember, this is over a 3-year period of time. So if we then do something which is called the geometric average, the time-weighted rate of return, and Bryan, you can see
basically say what average yield do you have to get every year to make 8.7% over 3 years?
Exactly. And you see the calculator website?
Yep.
Okay. So I'm just using, just to make it completely accessible, this is a website. It's not an endorsement, but it's just out there, calculator.net. There's a root calculator on there. And if I go down to the general root calculator, there's even a cube root calculator. But let's just say if I did over a 3-year period of time, and let's just say I needed to get 8.7%, I hit calculate, and that shows 2.06. So that means that the fixed indexed annuity, if it was returning 2.06% year 1, 2.06% in year 2, 2.06 in year 3. Of course, we know that those rates are really going to be maybe 0 in 1 year. We might have a great year in the other. We might have a so-so year in the third. But when you take the geometric average, as long as we're doing about 2% a year, which, Bryan, isn't that within the realm of possibility of what a fixed deferred annuity can offer?
Oh, absolutely. I would say that's probably on the very low end of expectations. Very, very low end, because you're looking at a 0, a 5, and a 2.3. That's be pretty weak performance just to get past that hurdle in the first few years. And I would say, when we would look at it, I say the worst contracts I've ever sold probably had growth that exceeded the surrender fee by the third year, and some really good ones by, after the first year. There's a lot of those actually.
Yeah, I was going to say, though, this is the back of the envelope where you can just pencil out, what is my surrender fee schedule? If I put $1 in this sort of math, you can see this is why. This is within the realm of possibility. So let me go ahead and stop my screen share, hand it back to you, and let's look at an actual case study.
Right, because I just have an annual statement, right? Let me see where that was. Oh yeah, it's right here. So this guy, this has been, a little over 2 years ago. I can't scroll and I can't highlight, but you can see my cursor.
Go ahead and share.
No, sorry, I haven't. Sorry. Okay. I got to share screen.
On the artwork for our podcast, you see potentially us on a couple of horses. It would be easier if we could just, trot out, but we're doing this virtually. So sometimes there's some bumps along the way.
That's okay. It was like, kind of, it's candid, right? We're not perfect. We're just really damn good. Okay. So you see what I'm looking at, Ashok?
I do.
You got it?
I see.
Okay.
Yep.
So here's the interesting thing. Obviously, this is a larger contract. It doesn't mean everybody's got to do it this way. This is just a really good example. We got through the first year and it said, hey, would you mind if I'll redact the information? So obviously his name and account number and all that stuff. So you see my name and it's an IRA. And he put in $500,000. So he had a fantastic first year. He made $60,000. So a little over 12%, which is, hey, you can't tell me it was 1 year and this guy's a total believer, right? And his surrender value now is $522,000. So the surrender fee went down like by 1%, and his account value went up by 12%. He eclipsed it. He could walk away from this contract after the first year, 522, and he could walk away with a little over 4.5% interest, right? So tell me why that's not a good deal. Safe money. This happened in 2020. This was after COVID. I can tell you, nobody foresaw the market coming up all the way where it's at now. Everybody was nervous. He'd lost a bunch of money in the security side of his portfolio. He goes 12% up, but his surrender value over that time period. And if you think about the context of the era we were living in the summer of 2020, holy cow. I mean, that's amazing. So he's above water and he's got a plus side after 1 year. Now this contract's got 7 years left to go. And I think his second year, he did about 3.5%, maybe 4%. So he crept up a little more, but, man alive, that's a pretty dang good deal. So, as simple as it gets, that's a real statement. And I asked him, he said, I'm proud of it. You can share it with whoever you want. So I thought it was pretty cool.
You know what I like about that? Here's some observations I have. Number one, we want our clients to actually, when we're doing our planning, keep it during the whole surrender fee schedule. So even though Bryan is saying, look at how the value is after year one, still our guiding thing is this money was meant to be originally on deposit for a period of time. But look at what happens if, importantly, number two, the contract is configured for upside. This is why we like that particular design. Is had you put him into something with maybe a 2% or 3% cap, then the numbers would be radically different. Your contract design was for, what have we talked about before, Bryan? We've talked about knowing when a contract is for accumulation or income. In that particular case, I'm guessing your client was focused on accumulation. You put him into a contract where there was no cap. It was potentially unlimited upside, and hopefully the participation levels were stable upon renewal. But that's an example of where, when we look at that design, mathematically, we know if the client, worst case, something changed in his life, we haven't hopefully done any damage there. That's my takeaway.
Absolutely. And this one, the title of that article, I put it out in a newsletter. The title of it is What It's Like to Own a Good Annuity. And again, I talk about he could surrender it, but he'd be crazy to do it. He got 12% his first year. He's above water on his surrender fees. He's not touching that because, again, we put it in the right context. It works for his portfolio. So the year before, I had written a newsletter about him. It was kind of how to beat a guaranteed income contract. Now, this guy chose to do the deferred accumulation with the maximum upside, and he won in a big way. And instead of him trusting me and believing me, now he knows it, right? Because it's real deal. It's there for him. And so I put it out there again, and I linked the past article, How to Beat a Guaranteed Income Contract, which we've talked about in the past several weeks with, income contracts, income versus accumulation, all those things. So we don't need to go back to that, but we'll probably do more case studies. That's a beautiful case study, and it fits right in with, why surrender fees are not a big deal. You've got to be kidding me. There's nothing wrong with them. So there's the first example.
I love it. Now, the second one in your article is that you said people can maximize the withdrawal from a potential contract and get a substantial amount of money out before the surrender period ends. Can you walk us through that?
Yeah. So I guess there's a lot of stories, and it goes back to certainly one person. I told you already about the couple where I service contracts that they bought from somebody else, and I've been doing it for 7 or 8 years now, just because I like them, and I would consider, they're in my, if I had to count them all in one hand, like these guys in Colorado are my favorites, right? They're like family. I love them to death, and so I try to do the right thing for them. But they're really so what they did is they bought the contracts, and they didn't need the money, or they didn't need the income. They just wanted to protect it. But the guy put them into a guaranteed lifetime withdrawal benefit, and they were paying 1.25% in fees. And, I looked at it and said, well, why are you paying? And it was a fair bit of money. It was like 4 contracts, a total of about $700,000. So 1.25% fee. What is that? It's $8,750 per year. But then again, the GLWB value rolls up, right? So the fee grows over time. And about the third year, I said, cancel the income rider. And so he did, and he probably saved himself well over $100,000 in the last 8 years on doing that. But because the contract was built for maximum income, there wasn't a really healthy growth aspect to it. And so the most they would get in a year was maybe 2.5%. And while all their other assets were going up, they felt like, they did like the safety, and they had probably, for their goals, they had a pretty modest expectation, 4 to 5% interest rate. So they're never that risky. But they said, I just don't like being stuck into the annuities. And that's where, I've written other letters about that. You're never just stuck. And the thing is, they have left them alone, but they could have. And I'll show you the example, Ashok. You don't have to just stick it there, because if you pull out the full 10% free withdrawal, right? This is what's going to happen. So let me blow this up a little bit. Tell me when you can see it real well.
Yeah, now I see it.
Okay, so what I have this program to is just a full 10% maximum withdrawal. So you put in $100,000. This is the guaranteed minimum. This means if the account never grows, this is what the insurance company guarantees. You're guaranteed to never lose money. You're guaranteed to never pay a fee. Okay, so if you look at this, this gives you, so you pull 10,000 out the first year, you got 90 left, and then you get 9,000, and then the math gets a little bit trickier, but it all lines up. And so we look at pulling it out through the 10th year, right? You've pulled out 61% of the money, and you still have, 39% of it left, right? So that's at a guaranteed minimum. So if there's a scenario in your retirement, now I'm going to say, if you plan on liquidating 60% of your portfolio in the first 10 years of retirement, you either have an advisor that doesn't know what he's doing, or you didn't do a good enough job preparing for retirement. And I'm not trying to, we got to be honest, this is a serious deal, right? Any questions on that, Ashok?
No.
Okay. So if I go down, to the past 10 years, and I give a 5.64% rate, which is what do we talk about? It's somewhere in the middle of the zero versus the top end. We've looked at this contract before, and a few episodes back, and we can illustrate at 10% if we want to, but we're going to go in the middle of that. So 5.6. And what happens is, obviously, if the account's growing, now, here's one thing about the surrender values that I look at. If you look at these two values here, right? You pulled $10,440 out. Your surrender value is $97,972. So you're above water, right? Right?
Mm-hmm.
But if you look at the bottom of it, that's $77,000. So you pulled 77% of the account out over time, and you still have $67,000 left. Huh. Well, I don't think that's such a big deal, right? Pull a tremendous amount of money out and still have a substantial remainder left. And again, once you get to 10 years, these two lines match up. Surrender value, accumulation value, equal throughout, all the way down, right?
What you're saying is that when you're taking out 10% out of a growing contract at the end of 10 years, you should hopefully have, based on how the contract has performed, the money that you have out should hopefully still have left enough money still inside the contract, assuming it's
if you get a 4 or 5% yield, you'll pull a majority of the money out and still have a big remainder left.
Bryan, does it show, by the way, if the contract had performed the poorest, what would that look like?
Yeah, we can done. So lowest effective rate would be the red. So that's still 60,000 remaining. I don't know the exact math. The highest was 6.88, which means 75,000 remaining. You're talking, and then obviously the most recent is the one we looked at, but you're talking about safe money.
Exactly.
Like A+, superior company. Yeah, surrender fees are not a big deal. You're protected, guaranteed. You got access to it. You can drain the account if you want to. And again, it's not to say you got to take it out to spend it. You can take it out. You can rebalance. You can move back and forth. Obviously, there's some tax implications of, non-qualified contracts that are, bought with after-tax money. But a lot of people are using IRAs. So there's a tremendous opportunity to do some rebalancing depending on the tax situations of the classification of the account.
Well, I think at the end of the day,
pretty simple.
Yep. Surrender fees. They're important to consider. We obviously try to make sure the fundamental design of the contracts we use are the best performing ones out there. And we are cognizant of what surrender fee are, when we do our planning. But at the end of the day, like you've said, there are some mechanisms that we can take advantage of to hopefully, if something changes in that planning, there's some mitigating circumstances that can hopefully address those concerns.
Absolutely. No, I agree. And I think we covered it pretty well. Again, if you guys want to chat with either one of us, I'm doing a big website redesign on Annuity Straight Talk. So we're going to have some more interactivity in the next few weeks. But any page on the website from now and forever is got a schedule a call button. Ashok's going to have his calendar up soon, but if anybody wants to get a hold of him, you can touch base with me. I'd be happy to connect you guys. I don't know. You want to plug your phone number, Ashok? You've been here long enough.
Sure. Well, there's the easy way is to give us a call, 800-438-5121. The number at Top Planning is a little bit different. It's 877-234-PLAN, 877-234-PLAN. But again, if you want to give us a call at the regular Annuity Straight Talk number, you can talk to Bryan and he can also connect with me right there. But either number works.
I might have a press 2 to talk to Ashok pretty soon. We'll see. We'll see. And no, if you like the podcast, go ahead and subscribe. If you want to see the illustrations and the videos we put up, or you want to look us in the eye, we're getting better at recording this. So I'm trying to look at the camera instead of look at my computer in my new office. But go ahead and subscribe to the podcast on any of the platforms where you enjoy podcasts. And you may also see the videos on youtube.com. Go to youtube.com, search Annuity Straight Talk. All the episodes are there. Subscribe to it. You get notified as soon as a new episode comes out. And again, also we want people to understand that they can comment. Let us know what you think. It's good for us to know how we can fine tune the message to maybe offer greater clarity or detail in areas where it's needed. And it's also helpful for other people to have, they call it social proof, where someone may become, you're going to help other consumers as well say, hey, no, I get it. That's the question I had. And they'll feel better about themselves. So we're really about empowering and building confidence in the retirement community. That's what we're here to do, right, Ashok?
Completely agree. This is another Annuity Straight Talk podcast where the whole purpose is to hopefully give people a different perspective on annuities and see where it may or may not fit into their financial planning.
Yep, that sounds great. Well, I want to thank you for the idea. It was a good topic, and hopefully everybody got something out of it. Again, come see us next week when we release a new episode, and I'm going to go watch college football, make my beef stroganoff. I don't know, Ashok. I'm ready to go. How about you?
Ready. Take care, everybody.
Have a great weekend, everybody. Bye.
You have been listening to Annuity Straight Talk. The preceding information is for informational and educational purposes only and does not represent tax, legal, or investment advice. The views expressed by guests on this program are their own and do not necessarily reflect the views of Annuity Straight Talk or its partners. No information presented today should be acted upon without meeting with a qualified and licensed professional. It is important that you read all insurance contract disclosures carefully before making a purchase decision. Guarantees are based on the financial strength and claims paying ability of the insurance company.
Ashok S. Ramji is an investment advisor representative of Insight Folios, Inc., an SEC-registered investment advisor. The firm only transacts business in states where it is notice filed or is excluded or exempted from notice filing requirements. Any fee-based financial planning and investment advisory services are offered through his association with Insight Folios, Inc. Top Planning LLC is not a registered investment advisor and is not another name under which Insight Folios provides services. Insurance products and services only are offered through Top Planning LLC. Insight Folios, Inc. and Top Planning LLC are not affiliated companies.